Imagine knowing exactly how to extract value from global chaos without actually having to, predict the future.
Right.
Think about that for a second. What if the absolute secret to navigating massive macroeconomic shifts isn't forecasting the next big trend? What if it's simply harvesting the present?
It's the ultimate trap, really.
Yeah. Are you constantly trying to guess where the market is going instead of capitalizing on where it is right now?
For anyone running a book or managing global exposure, it is the trap. We're just obsessed with tomorrow. The whole institutional mindset is constantly trying to price in the terminal rate or the 6-month forward curve or the end of a geopolitical conflict.
Always looking over the horizon.
Exactly. And in doing so, capital allocators completely step over the massive structural inefficiencies that exist right under their feet today.
Welcome to today's deep dive. Our mission is to unpack the incredibly complex, highly tactical macroeconomic landscape of the euro to US dollar currency pair for March 2026.
It's a huge topic.
It is. We are looking at a masterclass in what the most sophisticated institutional players call an incentive harvest strategy.
Which is brilliant.
Yeah, it's this highly mechanical way to navigate a market that is currently caught in a massive tug of war. You've got European policy shifts on one side and explosive Middle Eastern geopolitical stress on the other.
It is a fascinating dynamic to model. You have these two massive economic engines operating under completely different sets of capital incentives. And meanwhile, external terms of trade shocks are they're throwing traditional correlation matrices right out the window.
Completely out the window. And whether you're managing global FX exposure, trading sovereign debt spreads, or if you're just fiercely curious about how institutional liquidity actually moves around the globe, this deep dive is going to completely reframe how you look at market volatility.
We are talking about trading the now.
Trading the now. Stop the guessing games. Stop the endless forecasting. Let's look at the institutional reality on the ground.
Which is exactly what the smartest prop desks are doing right now. They aren't making these sweeping generational bets on the direction of the global economy.
Right.
They are looking at the current liquidity parameters, they're identifying the algorithmic boundaries, and they're systematically extracting value from the mean reversion.
Okay, let's unpack this. We need to set the stage by looking at the specific pricing structure, because the tape tells a wild story right now.
It really does.
In early March 2026, the current spot price for USD is hovering right in this massive congestion zone around 1.178 to 1.18.
Yep.
Now, over the past month, the euro has softened. We've seen a slight dip. But if you look at the macro picture, if you look year on year, the euro is up a massive 12%.
And we really need to pause and appreciate the sheer market mechanics of a 12% move in USD.
It's not small.
It's not some low-float tech equity. This is the deepest, most heavily trafficked liquidity pool on the entire planet.
Right.
So for the euro to appreciate 12% against the dollar over a 12-month rolling window, you were talking about a seismic rotation of global sovereign capital.
Billions and billions.
Trillions, really. That is real money accounts, central bank reserve managers, massive pension funds aggressively migrating out of dollar-denominated assets and into the Eurozone.
I hear that, but let's push back on that narrative for a second. You call it a seismic rotation of capital, but wasn't a massive chunk of that 12% run simply a dollar short squeeze?
Whoa.
Because the market got way off sides, expecting the Fed to maintain terminal rates indefinitely. And when the narrative cracked, the unwind was violent.
That is a fair critique of the velocity, absolutely, but not the underlying structure.
Okay.
The velocity of the move was definitely exacerbated by systematic trend followers covering their dollar longs. They were caught.
Caught flat-footed.
Yeah, but the fundamental floor of that 12% run-up through late 2025 was driven by relative policy convergence.
Right, the ECB and the Fed.
Exactly. The European Central Bank stabilized their terminal rate. They stopped the forward guidance guessing game and just plateaued.
They drew a line in the sand.
And simultaneously, the U.S. swap markets aggressively repriced the Federal Reserve's dot plot, pulling rate cuts forward. So the yield differential, which is the primary gravitational pull for this currency pair, it narrowed violently.
So the structural advantage of the dollar was eroded, not just by sentiment, but by the actual yield curve.
Precisely. As that spread compressed, the incentive to hold dollars purely for the carry trade advantage just evaporated. Capital flooded into the euro to capture the relative value before the ECB eventually pivots.
But right now, here in March 2026, The price action is dead.
It looks dead.
The base rate is wedged in this incredibly tight 1.178 to 1.18 range. The algorithmic flow just seems completely paralyzed. Now, if you're looking at a standard daily chart, it looks like momentum just died. The moving averages are flattening out.
Yeah.
But I don't buy that. This isn't a stalled engine. It is a coiled spring.
That is the exact mental model you need to have. When a massive macro trend covers that much ground that fast and then suddenly compresses into a 50 pip range, volatility isn't dying.
It's resting.
It is being warehoused. Gamma is building up at these strike prices in the options market.
Think about that 12% historical run-up like an expedition climbing a massive mountain.
I like that analogy.
You have spent months pushing upward, chewing through massive resistance levels, gaining altitude, but you don't just sprint from the base to the summit.
No, you die.
Right, you hit a specific altitude and you set up base camp. That is exactly what this 1.178 to 1.18 range is. It is an institutional base camp.
Exactly.
The market isn't pushing for the 1.20 summit right now. It is resting, it is absorbing the massive inflow of the last year, and it is waiting to see what the geopolitical weather does before making the next push.
And right now, the macro weather outside that base cap is highly hostile. The overarching narrative has fundamentally shifted from a pure rates differential story to a deeply complex risk premium pricing model.
But the real story is what is happening in the Middle East.
Yes.
You cannot look at the G10 currency complex in March 2026 without pricing in the massive escalation in the Middle East, specifically the U.S. and Israeli actions in Iran.
It's the elephant in the room.
It is dominating the institutional flow, and it has triggered a massive global safe haven bid for the U.S. dollar. The DXY is showing real, undeniable strength, sitting right around 97.7.
Yeah.
And the immediate derivative of this conflict is the absolute spike in crude oil.
What's fascinating here is the duality of the U.S. dollar in these specific macro conditions.
Duality how?
Well, the dollar acts as two entirely different instruments depending on the volatility index. In a low volatility economic expansion phase, it trades as a yield play. You hold it for the interest.
Right.
But when the geopolitical risk matrix explodes, the dollar completely transforms. It stops trading on interest rate differentials and starts trading purely as the global liquidity bunker.
But hold on. If the DXY is sitting at 97.7 purely on fear, aren't we just pricing in a tail risk that might not actually materialize into a broader contagion?
That's the billion-dollar question.
Like, how much of this dollar strength is actual permanent institutional repositioning versus just algorithmic panic hedging?
That is the exact differential you have to map out. Right now, we are seeing risk premium strength, not policy premium strength. This is defensive capital hoarding.
Okay.
But to your point, it is highly reactive. The reason it is so sticky right now is because of the transmission mechanism of the oil spike. This isn't just about headlines, it's about terms of trade.
Right, because this is where the divergence between the U.S. and European economies becomes critical to the currency pair.
Yeah.
Let's dig into the energy markets.
The Eurozone is heavily reliant on imported energy to power its industrial base.
Extremely reliant.
When you have a geopolitical shock in the Middle East that spikes Brent crude and global LNG prices, you are essentially slapping a massive instantaneous tax on the entire European manufacturing sector.
Well, the U.S. is fine.
The United States, conversely, is insulated by its own shale production and export capacity.
So an oil spike hits the USD pair from both sides simultaneously.
Exactly.
It creates a massive terms of trade shock for Europe, widening their trade deficit, while the U.S. essentially absorbs the shock internally.
For the ECB, this is the nightmare scenario. It actively destroys European growth margins while simultaneously importing headline inflation.
Stagflation.
They are caught in a stagflationary impulse. They cannot hike rates to defend the currency because it would bankrupt their industrial core, and they cannot cut rates to stimulate growth because it would pour gasoline on the inflation fire. The euro is punished violently in this scenario.
Which perfectly explains the massive gravitational pull down toward 1.1 mid. Capital is fleeing the structural vulnerability of the Eurozone's energy deficit and parking itself in the energy independence of the U.S. dollar.
Exactly.
But this raises a massive red flag for anyone blindly shorting the euro here. How long can a currency actually run on fear?
Not forever.
Right, because if the dollar is only strong right now because algorithms are terrified of a broader regional war, that means this dollar strength is structurally fragile. It is an artificial suppression of the euro.
That is the crux of the institutional debate right now. Fear is an incredibly powerful driver of capital, but it has a very short half-life.
Yeah.
If the geopolitical crisis does not fundamentally alter the long-term mechanics of global trade.
Like if the shipping lanes stay open.
Right, if shipping lanes remain open and production isn't permanently taken offline, then the risk premium eventually bleeds out of the pricing models.
And when that geopolitical risk premium evaporates, the market immediately snaps back to looking at the underlying economic fundamentals.
Let's zoom out for a second and look at the actual fundamental data in Europe, stripping away the geopolitical noise.
Let's do it.
Because despite the massive external pressure of the energy shock, the internal data coming out of the Eurozone is exhibiting massive structural resilience.
It really is, and this is the data that the headlines are completely ignoring.
Completely ignoring it.
Eurozone sentiment indicators are actively improving. Economic confidence across the bloc is testing multi-year highs. And the ECB is putting out remarkably methodical projections.
Very methodical.
They see food inflation settling just above 2%, and they are projecting headline inflation to successfully drift toward their target over the medium term. Furthermore, the overnight index swaps are pricing in a virtually zero probability of the ECB cutting rates this year.
What's fascinating here is that the ECB's absolute refusal to provide forward guidance, their rigid, neutral stance, has become a massive tactical weapon in the currency markets.
A weapon.
Yes, think about the positioning. They are not overtly hawkish. They are not threatening to hike rates, which naturally caps any extreme runaway strength in the euro that would crush their exporters.
But I have to challenge that framing.
Yeah.
You call it a tactical weapon, but isn't it just policy paralysis?
It looks like it, but
If energy is spiking and the industrial base is under pressure, the ECB is essentially trapped. Isn't their neutral stance just a nice way of saying they have absolutely no idea what to do, so they are doing nothing?
it looks like paralysis if you are looking for proactive stimulus, yes. But in the context of currency valuation, doing nothing is a highly aggressive signal.
How so?
By refusing to panic, by refusing to price in emergency rate cuts despite the geopolitical storm, they are anchoring the short end of their yield curve. They are signaling to the bond market that the European economy has the internal strength to absorb this terms of trade shock without requiring monetary life support.
Oh, I see.
That absolute lack of urgency completely removes the structural downside pressure on the euro.
So what does this all mean for the price action? It means the euro's internal engine is actually quite healthy. Any weakness we are seeing in the euro's pair, that algorithmic drift down toward the 1.178 floor, is being driven entirely by external transient panic, not by internal economic decay.
That distinction is paramount for capital allocation. You have to isolate whether an asset is repricing because its fundamental thesis is broken, or if it is merely absorbing a temporary liquidity shock from a hostile macro environment.
Right.
The underlying architecture of the euro is completely intact.
It is like watching a Category 5 hurricane swirl around a heavily reinforced storm-proof house.
Perfect analogy.
You look at the macro tape, you see the VIX spiking, you see Brent crude ripping higher, you see the geopolitical headlines flashing red, that's the hurricane, the algorithmic liquidity is drying up, the momentum traders are shorting the euro.
Yep.
But then you look at the fundamental data out of Frankfurt.
Yeah.
You look at the multi-year highs in economic confidence. You look at the sticky inflation data holding the ECB's feet to the fire. That is the storm-proof house.
Exactly.
The foundation isn't cracking. The central bank isn't breaking. The currency is just sitting there absorbing the volatility, waiting for the geopolitical storm to exhaust itself.
And understanding that reality of the structural support is solid, despite the superficial tape, is the entire foundation of the quantitative strategy we need to dissect. Because when you map out that the weakness is episodic and external, it completely dictates your execution algorithms.
Now here's where it gets really interesting. This brings us to the absolute core of our deep dive. The masterclass in incentive harvesting.
This is the fun part.
We've established the macro backdrop. We know the euro has massive structural support, but is being temporarily suppressed by episodic geopolitical risk-off flows. So how do institutional desks actually extract alpha from that?
Carefully, very carefully.
Right. The overall campaign bias for March 2026 is officially mapped as neutral to slightly bullish in the medium term, but violently volatile in the short term.
Which means standard trend-following strategies are going to get chopped to pieces.
Destroyed.
You cannot just buy and hold because the geopolitical headlines will trigger massive drawdowns. And you cannot aggressively short because the ECB's neutral stance provides a concrete floor. You have to be deeply tactical.
Yes, exactly. The execution strategy focuses on what quantitative models call harvest zones.
Huh.
The mandate is explicitly mean reverting. You systematically buy the liquidity dips when the price compresses toward the 1.17 level.
Yep.
And conversely, you harvest partial profits.
Yeah.
You distribute that accumulated position when the price rallies into the 1.185 to 1.19 resistance block. You're essentially providing liquidity at the extremes of the range.
You're acting as the market maker, essentially.
And the triggers for these active harvesting mechanics are built entirely around the March calendar, specifically ECB communications and U.S. data drops.
To properly execute this, you have to hard-code the philosophy into your risk management. In an incentive harvest campaign, you are not trading a new macroeconomic regime. Let me reiterate that, because it is where most retail capital gets slaughtered.
Say it again for the people in the back.
We are not trading a new regime. We are not positioning for a breakout. We are systematically extracting premium from the current incentive landscape while it persists. This is a highly tactical delta hedging operation executing inside a structurally incomplete macro transition.
Let's translate that institutional jargon for a second. A structurally incomplete macro transition. That means the global bond market is stuck in purgatory.
It's a good word for it.
We are halfway between the old regime where the Fed was aggressively hiking and the new regime where the Fed actually begins an easing cycle. We're in the messy high variance middle.
Yes, the macro transition hasn't cleared, and until the Fed actually moves or the ECB is forced to break their neutral stance, the currency pair is going to ping-pong violently between these structural boundaries based on the daily news cycle.
So let's stress test the actual mechanics of the harvest. Why do you step in and buy at 1.17? From a behavioral standpoint, it sounds terrifying.
No, it is. It goes against every instinct.
You are stepping in to buy the euro exactly when the price is plunging, the momentum indicators are screaming sell, and the news terminals are flashing red with Middle Eastern conflict updates. Why is 1.17 the magic floor?
Because you have to look at the microstructure of what is driving the take to 1.17. We've established that weakness into that zone reflects external liquidity imbalances. It is pure safe haven flow.
It's panic.
Exactly. It is capital blindly fleeing to the dollar liquidity bunker because of a headline. It is not structural repricing of the sovereign debt. The ECB didn't suddenly announce a massive quantitative easing program.
Right.
Therefore, that 1.17 level represents massive historical and options-related support. It is the exact point where the fear selling exhausts its inventory and the deep-pocketed fundamental value buyers step back in to absorb the flow. You buy at 1.17 because the data proves the panic is episodic.
Okay, so you execute at 1.17, you fade the fear, but then why aggressively cap your upside? Why sell into the 1.185 to 1.19 zone? If the euro is fundamentally superior in this specific yield environment, why not hold the position for a structural breakout to 1.22 or 1.25?
Because you have to respect the geopolitical reality you're operating within. The institutional market is simply unwilling to structurally short the US dollar while geopolitical rockets are literally in the air.
That makes sense.
You can have the most fundamentally bullish euro thesis on the planet, but no sane sovereign wealth manager is going to completely dump their dollar reserves when the risk of a Strait of Hormuz closure is sitting on the macro dashboard.
The risk is just too high.
The upside enthusiasm is strictly capped by the risk premium. So when the algorithmic flow pushes the price up to 1.185 or 1.19, it slams into a massive wall of risk aversion and profit taking.
This is the ultimate behavioral trap. Have you ever held onto an asset way too long? You nail the entry, the asset rallies, you feel like an absolute genius, and you just sit there waiting for a massive structural breakout.
We've all been there.
And then, agonizingly, you watch the liquidity dry up and the price fade all the way back down to your entry point. This incentive harvest strategy is the antidote to that greed. It removes prediction from the model.
Completely removes it.
You aren't trying to forecast if the conflict will de-escalate tomorrow or if the Fed will shock the market next week. It focuses purely on statistical asymmetry. You accumulate the asset when systemic stress peaks, and you distribute when the market temporarily normalizes. You are literally farming the volatility curve.
It requires cold, mechanical discipline. You have to force your execution against every emotional instinct. When the tape is terrifying and the momentum is deeply negative, you provide liquidity and buy.
Yeah.
When the tape feels safe and the price action is green, you don't get greedy. You clear your books. You harvest.
So what does this all mean for the actual data calendar? Because these algorithms don't just execute in a vacuum. Right now, the macro markets are reacting purely to high-frequency headlines. They are not repricing the long-term swap rates. They are trading the immediate news ticker.
Which means any robust model has to clearly define the invalidation points. If we are systematically harvesting a range, what macro event actually breaks the range?
Right. That blows it up.
There are three massive tail risks to monitor in March. First, the geopolitical risk metastasizing from a regional conflict into a global supply chain disruption. Second, a sudden violent spike in Eurozone inflation that forces the ECB off their neutral stance. And third, unexpected, undeniable strength in the U.S. labor market that forces the Fed to completely abandon their projected easing cycle.
And we map these risks directly onto the March economic calendar. And this is crucial. You have to stop looking at these economic calendars as just scheduled data releases.
They aren't just numbers on a screen.
In a compressed, highly volatile market, these events are kinetic volatility triggers. We are hyper-focused on Eurozone CPI, the nuanced language in the ECB minutes, U.S. non-farm payrolls, the ISM manufacturing index, and U.S. retail sales data.
If we connect this to the bigger picture, this raises an important question. Are we approaching a true macro regime shift? Because if the underlying structural parameters change, the entire harvest map becomes toxic.
Let's run through that. Let's game theory, the worst-case scenario.
Okay, if the Middle East conflict intensifies materially, if it chokes off global energy transit, and the resulting terms of trade shock genuinely breaks European economic growth, the paradigm shifts.
Right.
If German heavy industry is forced to idle because energy inputs are too expensive, the ECB's neutral stance shatters. They will be forced into emergency rate cuts to prevent a depression. In that scenario, the U.S. dollar becomes structurally dominant, not just temporarily strong. That 1.1 CN floor won't just break, it will gap down.
The stormproof house gets its foundation ripped out.
Exactly. In a true regime shift, mean reversion fails. You stop harvesting and you immediately flip your bias to trend following.
But conversely, you have to model the upside tail risk. What if the geopolitical risk premium suddenly evaporates? What if diplomatic back channels secure a ceasefire, the kinetic action stops, and Brent crude plummets back to baseline?
Then the artificial suppression of the euro vanishes instantly.
The fear just evaporates.
The fear evaporates, the massive safe haven premium bleeds out of the DXY, and the euro-USD pair violently resumes its long-term structural uptrend. Because in a vacuum of fear, the algorithmic models will instantly remember that the European economy is highly resilient and the Fed is still mathematically on a path to cut rates.
So that ceiling breaks.
If that geopolitical lid is removed, the 1.19 ceiling doesn't just break, it gets completely run over by short covering.
This is exactly why you have to view the March calendar as targeted jolts of electricity into the liquidity pool. Think about the U.S. non-farm payrolls report. It drops at 8:30 a.m. Eastern on a Friday. For weeks, the market has been slowly, grindingly ping-ponging between 1.17 and 1.1.
Yep.
Then, bam, the payroll data hits the tape. It's a sudden, massive injection of variance. In milliseconds, high-frequency algorithms parse the deviation from consensus.
Faster than a human can blink.
Exactly. Did the U.S. economy add 100,000 more jobs than expected? The U.S. yield curve spikes. The dollar rips higher, the euro instantly drops toward the 1.1 scale stirred floor, and the institutional harvesters step in to aggressively buy the overextension.
But what if it goes the other way?
Right. What if the U.S. severely misses on jobs? The dollar tanks, the euro spikes vertically toward 1.1, and the harvesters instantly dump their inventory into the rally. Every single macroeconomic data point is a precision moment to either scale into the fear or exit into the greed.
It is a purely mechanized, agnostic way of interacting with capital markets. You completely remove the directional bias, you define your execution zones based on historical liquidity and geopolitical boundaries, and you use the macroeconomic calendar purely as your liquidity mechanism.
Let's pull all of this deep macro theory together. We've covered an immense amount of institutional ground today. If we do a rapid-fire synthesis of the architecture we've built, March 2026 is entirely defined by volatility compression rather than trend expansion.
Spot on.
We have the incredible structural support of the euro, a highly resilient internal economy paired with a rigidly neutral central bank, clashing violently against episodic, fear-driven U.S. dollar strength caused by Middle Eastern energy shocks.
It's a perfect storm of opposing forces.
The resulting market structure is a massive state of ambiguity. But that is the alpha. Ambiguity is the absolute perfect environment for harvesting, not for trend writing. You do not need to forecast the geopolitical future. You just need to systematically harvest the algorithmic present.
But you must actively manage the timeline of the strategy. The macro conditions that make incentive harvesting so highly profitable only exist as long as the broader market remains trapped in this transitionary indecision.
It won't last forever.
This compression is mathematically finite. Eventually, the structural tension between the ECB's unmoving yield curve and the Federal Reserve's inevitable policy shift will become too immense, and it will violently break that one-point mean ceiling.
Or the floor.
Or, conversely, the geopolitical stress will permanently alter the global energy supply chain and shatter the 1.17 floor. The regime will eventually shift. And when the volatility expansion begins, you have to be ready to instantly kill the harvest algorithms and pivot to a trend rating mandate. You cannot keep mean reverting a market that has fundamentally repriced.
And that leads us to a final provocative thought for you to take away from this deep dive. Think about the sheer mechanical scale of what is happening under the surface right now. Think about the hundreds of billions of dollars currently programmed by institutional algorithms to play this exact tight ping pong game between 1.17 and 1.19.
It's a staggering amount of capital.
They're blindly providing liquidity at the floor and heavily shorting the ceiling over and over and over again. Every single time they execute that cycle, the coiled spring gets wound tighter, the open interest builds, and the market becomes more leveraged to these specific price boundaries.
And this is the ultimate structural trap of the macro market. The longer a tight consolidation range persists, the more institutional capital relies on its existence. The risk models get complacent.
They start to treat the range like a law of physics.
Exactly. The algorithms assume 1.17 will provide infinite liquidity forever. They assume 1.19 will cap every single macro rally.
So what happens on the exact day this regime finally breaks? What happens when a massive U.S. data point misses by 3 standard deviations, or a geopolitical event occurs that permanently alters the flow of crude oil?
It's going to be chaos.
In a fraction of a millisecond, the high-frequency algorithms and the massive institutional players are going to realize the range is structurally dead. And the race to unwind those tightly coiled, massively leveraged delta-neutral positions, the sheer panic of 1,000 funds trying to exit the harvest and chase the new macroeconomic trend, will create a market snapback so violent, so lacking in counterparty liquidity, that it will make the current geopolitical volatility look like a flat line.
It's the snap.
So the question you have to ask yourself when looking at your own systemic exposure is this: are you perfectly positioned to extract value from the harvest today? And far more importantly, are you hedged for the massive algorithmic snap tomorrow?
It is the ultimate test of macroeconomic awareness. Surviving the consolidation phase is a matter of discipline. Surviving the inevitable breakout is a matter of survival.
Keep monitoring the liquidity zones, respect the volatility of the macro calendar, and don't let the geopolitical headlines force you out of your quantitative framework. We will see you next time.